What actually changes when your credit score hits 832? Not what people think. Your income doesn't suddenly double, your job doesn't become easier, your life doesn't feel richer, but something does change, quietly, systematically. The system starts trusting you more than you trust yourself, and that's where things begin to shift. Let's take a normal scenario. You're 29. You live in a mid-sized city in the US or Europe. You earn about $70,000 a year, roughly $4,200 a month after tax. Your expenses look reasonable. Rent, $1,600, car payment, $450, insurance, $200, groceries, $400, subscriptions, phone, utilities, $300. You're left with about $1,250. Which sounds fine, until life fills the gaps. Weekend dares, short trips, upgrading your phone, replacing things that don't feel good enough anymore. And slowly, that $1,250 disappears. Not dramatically, just quietly. Now, imagine this same person reaches an 832 credit score. Suddenly, everything changes, not in your bank account, but in your access. Banks offer you lower interest rates, higher credit limits, pre-approved loans, better mortgage terms. You're no longer risky, you're valuable. And here's the uncomfortable part. The system rewards you for your ability to take on more debt. Most people assume a high credit score means financial success, but it actually measures something else: consistency in borrowing, reliability in repayment, not wealth, not independence, just behavior within a system built around debt. So what happens next? You upgrade your lifestyle, not because you plan to, but because you can. You finance a better car, you move into a nicer apartment, you feel safe using your credit card more often, because now it's under control. Let's run simple numbers. You take advantage of your great credit score and upgrade your car. Payment goes from $450 to $750. Move to a better apartment. Rent goes from $1,600 to $2,100. That's an extra $800 per month, or $9,600 per year. Now, assume that money could have been invested instead, even conservatively, at 7% annually over 10 years. That's roughly $132,000. Not spent, not wasted, just redirected. That's the real cost. Not the interest, but the lost opportunity. So why do people do this, even when they understand the math? Because of something subtle. A high credit score doesn't just change how banks see you, it changes how you see yourself. You feel responsible, disciplined, in control. And that creates a quiet confidence, but it also lowers your resistance to spending, because now debt feels safe, not dangerous. And once debt feels safe, it becomes invisible. Fast forward 10 years. Two people. Same income, same starting point. One used their high credit score to expand their lifestyle. The other used it sparingly. The difference isn't dramatic at first, but over time, it compounds. One is still making payments. The other is building assets. One has flexibility, the other has obligations. And the gap between them isn't income. It's decisions made when things felt easy. Financially intelligent people don't see a high credit score as a reward. They see it as a tool, access, not permission. They understand something simple. Just because borrowing is cheaper doesn't mean it's beneficial. They don't rush to use credit. They become more selective with it, more intentional, because they know the real advantage isn't in having access to debt, it's in not needing it. An 832 credit score doesn't make you rich. It makes you trusted by lenders. What you do with that trust determines everything. Not immediately, but quietly over time. And most people never notice the shift until years later when their income looks good, their life looks stable, but their options feel limited. not because they made a mistake, but because they followed what felt normal.